Before we begin today's analysis, a brief word. If you're here for thoughtful, disciplined financial education without the noise, consider subscribing to this channel. We focus on rational strategy, market fundamentals, and the kind of emotional discipline that separates successful long-term investors from the crowd. You'll find the subscribe button below in red. No pressure. Just consistent professional financial insight when you need it. Now, let's get to work. Something significant just shifted in global financial markets. A major move in the silver market, linked to Chinese institutional activity, has sent ripples through commodities, currencies, and equities simultaneously. Wall Street responded with unexpected strength, Asian markets showed volatility, and many investors woke up to positions that looked very different from the night before. This isn't about a single day's price action. This is about understanding what happens when large institutional capital moves decisively across borders, across asset classes, and across the assumptions most retail investors hold about market stability. Today, we're going to examine this power shift with the seriousness it deserves. We'll explore what happened, why it matters, and most importantly, what you should actually do about it. No hype, no predictions, just clear-headed analysis for investors who take their capital seriously. Let's establish context. Silver has always occupied a unique position in financial markets. It's both an industrial metal and a monetary metal. It's used in solar panels, electronics, and medical applications. But it's also held as a store of value, particularly in times of currency uncertainty. This dual nature makes silver particularly sensitive to both economic growth signals and financial system stress. When a large institutional player, what traders call a whale, makes a significant move in silver markets, it sends multiple signals simultaneously. It tells us something about industrial demand expectations. It tells us something about inflation concerns. It tells us something about currency confidence. And when that move is connected to Chinese institutional activity, the signal becomes even more complex. China is the world's largest silver consumer. It's also navigating significant economic transitions, currency pressures, and shifting relationships with Western financial systems. So when we see major silver accumulation or disposition linked to Chinese institutions, we're not just watching a commodity trade. We're watching geopolitical capital flows, monetary policy signals, and strategic positioning all at once. Here's what the evidence suggests. Recent weeks have seen unusual activity in silver futures markets, physical silver flows, and related financial instruments. Large institutional orders, traced through exchange data and shipping records, indicate significant Chinese involvement. Some of this appears to be accumulation. Some appears to be strategic repositioning away from dollar-denominated holdings. The timing coincides with several macro factors: weakening yuan pressure, shifting U.S.-China trade dynamics, and changing expectations about Federal Reserve policy. Wall Street's response was notable. Rather than showing concern about capital outflows or commodity volatility, U.S. equity markets rallied. Why? Because sophisticated institutional investors read the move as a signal that Chinese capital is rotating, not fleeing, that global liquidity remains abundant, that the worst-case economic scenarios are off the table. They also saw opportunity in the currency and rate implications. When foreign institutions move aggressively into hard assets, it often precedes a weakening of their home currency. That makes U.S. assets relatively more attractive. That brings more capital into U.S. markets. So what looked like a concerning shift to retail observers looked like a green light to institutional players. This divergence in interpretation is exactly where individual investors need clarity. Let's step back and examine the larger cycle at work. Markets move in waves, driven by capital flows, credit cycles, and shifting risk appetites. We've been in an unusual period where central bank policy, fiscal stimulus, and post-pandemic recovery created distortions in traditional market relationships. Precious metals, including silver, have been caught in a strange position. Inflation has been elevated, which should support precious metal prices, but nominal interest rates have also risen, which typically pressures non-yielding assets. The result has been choppy, directionless trading that frustrated both bulls and bears. What changes this stalemate? Large institutional moves that signal a break in the equilibrium. When major players commit significant capital based on their macro outlook, they force a repricing. They create the volatility that allows markets to find new levels. This is what we're seeing now. The Chinese institutional move, whether it's accumulation or strategic rotation, represents a macro bet. It's a statement about future inflation, currency values, and geopolitical risk. Wall Street's rally suggests U.S. institutions are making a different but complementary bet. They're wagering that capital flows favor dollar assets, that U.S. economic resilience continues, and that the current environment favors risk assets over defensive positions. Both can't be fully right, but both reveal important information about where smart money is positioning. Here's where most investors get into trouble. They see a dramatic market move and feel compelled to react immediately. They read headlines about whales and power shifts and think they need to make a corresponding change to their portfolio right now. This is exactly backward. Professional investors and institutional players aren't reacting to headlines. They're acting on research, models, and strategic frameworks developed over months or years. By the time retail investors read about a move, the move has already happened. The opportunity isn't to chase what already occurred. The opportunity is to understand what it reveals about the current market structure. Consider the psychological trap. You see that silver surged. You think you missed an opportunity. You feel urgency to get in before it goes higher. Or you see Wall Street soared without you. You feel fear of missing out. You rush to add an equity exposure at what might be a temporary peak. Both responses are emotionally driven, not strategically sound. The disciplined approach is different. You ask, what does this move tell me about macro conditions? How does that affect my existing positions? What adjustments, if any, align with my long-term strategy? You don't ask, how can I make money from this news right now? That distinction is everything. Let's examine a critical layer most observers miss: currency dynamics. When Chinese institutions move into silver or other hard assets, they're often making a statement about the yuan. They may anticipate currency depreciation. They may be hedging against capital controls. They may be diversifying away from yuan-denominated assets. This has direct implications for global currency markets. A weaker yuan makes Chinese exports more competitive. It affects commodity demand. It shifts relative valuations across all emerging market currencies. For U.S. investors, this creates both risks and opportunities. A weaker yuan can pressure U.S. corporate earnings for companies with Chinese exposure, but it can also make U.S. assets more attractive to global capital-seeking stability. The dollar's role as the global reserve currency means that in times of uncertainty, capital flows toward dollar assets almost reflexively. This is part of why Wall Street rallied even as the silver move suggested concern elsewhere. The market was pricing in a scenario where capital flows favor U.S. assets, regardless of the concerns driving those flows. Understanding this currency dimension is essential for making sense of seemingly contradictory market signals. History offers valuable perspective. We've seen similar patterns before, large cross-border capital moves that precede significant market repricing. In the late 1990s, Asian capital flows into U.S. treasuries, and equities helped fuel the tech boom. When those flows reversed during the Asian financial crisis, it created massive volatility. In the mid-2000s, petrodollar recycling and Chinese accumulation of U.S. assets kept interest rates low and asset prices high. The reversal contributed to 2008's crisis. In 2013, the taper tantrum showed how quickly emerging market capital could shift when Fed policy signaled change. Each time, the pattern was similar. Institutional players moved first, markets repriced, and retail investors either benefited or suffered based on whether they understood the underlying dynamics. The current situation has echoes of these past episodes. We're seeing capital reposition across borders, across asset classes, and across assumptions about future policy and economic conditions. The winners will be those who understand the strategic implications, not those who react emotionally to daily price changes. Several powerful macro forces are converging right now. First, central bank policy remains in flux. The Federal Reserve is navigating between inflation concerns and growth concerns. Chinese authorities are managing both currency stability and domestic economic stimulus. Second, geopolitical tensions continue to influence capital allocation. Trade relationships, technology restrictions, and strategic competition all affect where institutions park their capital. Third, the global commodity complex is being reshaped by energy transition, industrial demand shifts, and supply chain restructuring. Silver sits at the intersection of all three forces. It's affected by monetary policy through its role as a monetary metal. It's affected by geopolitics through mine locations and processing capacity. It's affected by the commodity complex through industrial applications, especially in solar and electric vehicles. When you see a major move in silver linked to Chinese institutional activity, you're really seeing these three macro forces expressing themselves simultaneously. Wall Street's rally reflects a reading of these same forces. Investors there are betting that policy remains accommodative enough to support asset prices, that geopolitical risk is manageable, and that economic growth continues to support earnings. They may be right or wrong, but their positioning reveals their interpretation. If you currently hold silver, precious metals, or related assets, here's how to think about this moment. First, review why you own what you own. Were you holding silver as an inflation hedge, as a currency hedge, as a speculation on industrial demand? Your reason matters because it determines whether this move validates or challenges your thesis. If you owned silver because you expect long-term currency debasement, a temporary spike driven by institutional positioning doesn't change your thesis, you hold. If you owned silver as a short-term trade expecting a breakout, you need to assess whether the move is complete or just beginning. But be honest, if you're asking that question, you're probably not in a strategic position. You're speculating. Second, consider your overall portfolio balance. Has this move created an oversized position? Are you now more concentrated in commodities than your risk tolerance warrants? Professional investors rebalance when market moves create imbalances. They don't let emotion or attachment to a winning position override portfolio discipline. Third, think about correlation risk. In volatile markets, correlations can shift rapidly. Assets that normally move independently can suddenly move together. If you hold both precious metals and emerging market equities, for example, you may have less diversification than you think if we're entering a period of yuan weakness and capital flight. The disciplined move isn't necessarily to sell, it's to reassess. Do your current holdings still serve your long-term objectives? Do they reflect your actual risk tolerance? Are you positioned for scenarios that still seem probable? If you're considering entering positions now, here's the harder truth. You're late to this particular move. The institutional players who drove the silver activity in the Wall Street rally acted weeks ago, maybe months ago. Does that mean there's no opportunity? No, but it means the opportunity isn't to chase what already happened. Instead, ask better questions. What does this reveal about where we are in the macro cycle? If Chinese institutions are rotating into hard assets, what does that tell us about currency and inflation expectations? If U.S. equities can rally despite global uncertainty signals, what does that tell us about relative strength in capital flows? The opportunity might not be in silver itself. It might be in assets that benefit from the same macro forces driving the silver move. It might be in currency positions. It might be in specific sectors that benefit from Chinese economic stimulus or U.S. relative strength. Or the opportunity might simply be to wait. If this move represents the early stages of a larger capital rotation, the best entry points may come during the inevitable consolidation or pullback. Here's a framework. Don't chase price. Chase value exposed by new information. The silver move and Wall Street rally give you new information about institutional positioning, macro forces, and market structure. Use that information to evaluate whether assets are mispriced relative to probable futures. Don't use it as a signal to buy whatever moved. First principle, position sizing matters more than position selection. You can be right about the direction and still suffer if you've sized a position too large. Volatility will shake you out before your thesis plays out. Professional investors use position limits based on volatility, correlation, and portfolio impact. If you're considering a silver position, for example, think in terms of what percentage of my portfolio can I risk in a volatile, non-yielding asset? For most individual investors, the answer is probably 5% to 10% maximum. Second principle, liquidity is a feature, not a bug. In volatile markets, the ability to exit a position matters enormously. Silver futures are liquid. Major silver ETFs are liquid. Small mining stocks are not. Physical silver can have wide bid-ask spreads. If you're building positions in this environment, prioritize instruments you can exit cleanly if conditions change. Third principle, hedging beats hoping. If you hold assets that could be vulnerable to the macro forces at play here, emerging market exposure, currency risk, commodity sensitivity, consider whether hedges make sense. This doesn't mean turning every position into a complex option strategy. It means thinking about how different parts of your portfolio interact under stress. Sometimes the best hedge is simply holding cash. It seems boring until markets are in turmoil and you have dry powder to deploy at better valuations. One specific opportunity worth examining: currency hedged international exposure. If the macro scenario involves yuan weakness and dollar strength, international equities might underperform simply due to currency headwinds. But currency hedged versions of international equity funds remove that variable. You get exposure to international corporate earnings without the currency risk. This isn't a recommendation to rush out and buy any specific fund. It's an illustration of strategic thinking. You take the new information, capital flows suggesting currency pressure, and ask, how does this affect my existing exposure? What adjustments eliminate risks I don't want while preserving exposures I do want? That's portfolio management. That's the discipline that compounds wealth over decades. Now we need to address the specific errors that destroy capital during market shifts like this. Seeing dramatic market moves triggers emotional responses: fear of missing out, fear of loss, excitement about potential gains. Professional investors expect these emotions and have processes to prevent them from affecting decisions. Individual investors often don't. They feel the emotion and they act on it immediately. The discipline: never execute a trade based on an emotion. Feel the emotion, acknowledge it, and then step away. Wait 24 hours. If the trade still makes strategic sense tomorrow, execute it then. Whatever happened most recently feels like it will continue forever. Silver surged, so it must be going higher. Wall Street rallied, so the uptrend must continue. Markets don't work this way. They mean revert, they overshoot, they correct. The discipline asks not what happened, but why did it happen, and are those conditions likely to persist? Leverage amplifies both gains and losses. In volatile markets, it can turn a manageable loss into a catastrophic one. Some investors see a strong market move and think, if I use margin, I can make twice as much. They forget that leverage also means a smaller adverse move wipes them out entirely. The discipline: in uncertain macro environments, reduce leverage, don't increase it, protect capital first, capture upside second. Many investors have long-term plans, target allocations, and investment policies. Then markets move dramatically, and they abandon everything to chase the new narrative. Years of disciplined strategy get thrown away for a tactical bet that may or may not work out. The discipline: your plan exists for moments exactly like this. Major market moves are exactly when you need discipline most, not least. Headlines tell you what happened. They don't tell you what it means or what to do about it. Reading that a silver whale made a move gives you a data point. It doesn't give you a strategy. The discipline: consume news for information. Make decisions based on analysis of how that information affects your specific situation and objectives. The opposite error is doing nothing when adjustment is warranted. Some investors get so afraid of making a mistake that they freeze entirely. If your portfolio is genuinely misaligned with current conditions and your risk tolerance, inaction is itself a decision, usually a poor one. The discipline: distinguish between strategic patience, holding a long-term position through volatility, and paralysis, being unable to make necessary adjustments. Here's a perspective shift. Volatility is a tool, not a threat. When markets are calm and trends are smooth, it's hard to find mispriced assets. Everything gets efficiently priced. When markets are volatile and capital is moving dramatically across borders and asset classes, mispricings emerge. Professional investors and institutional players wait for exactly these moments. They've done their research. They know what assets are worth under various scenarios. When volatility creates a temporary price disconnect, they act. Individual investors can do the same, but it requires preparation. You can't do the research during the volatility. You have to have done it beforehand. You need to know before markets move what assets you'd want to own at what prices. Then, when volatility creates those prices, you execute calmly. This is the opposite of emotional trading. This is strategic opportunism. If you haven't done that preparation, your job right now isn't to trade. It's to prepare for the next opportunity. Build your watch list. Identify assets you'd like to own at better valuations. Determine what price would represent genuine value. Then wait. Volatility will come. It always does. A critical skill: knowing what information matters. Not every market move is meaningful. Not every headline represents a strategic shift. How do you tell the difference? Volume and follow-through matter. A single day's price spike on low volume could be a technical anomaly. Sustained moves on high volume represent genuine repositioning. Multiple confirmation signals matter. If silver moves but gold doesn't, that's interesting but ambiguous. If silver, gold, currency markets, and bond yields all move consistently with a single narrative, that's a signal. Institutional behavior matters. What mutual funds, pension funds, sovereign wealth funds, and endowments do carries more strategic signal than retail trader activity. The silver whale story, if accurate, matters because it represents significant institutional capital making a macro bet. Wall Street's rally matters because it represents broad institutional positioning, not individual stock gambling. Learn to filter. Most daily market noise is exactly that. Noise. Focus on the signals that reveal real shifts in capital allocation, sentiment, and macro conditions. Let's zoom out to the only time horizon that really matters. Decades. Markets go through cycles. Capital flows shift. Geopolitical dynamics evolve. Asset prices fluctuate. None of that changes the fundamental principles of long-term wealth building. Own productive assets. Maintain diversification. Control costs. Manage risk. Stay disciplined. Whatever happened with silver and Chinese institutions this week, next month, next year, it's a footnote in the larger story of global capital markets. Your job isn't to predict or profit from every shift. Your job is to build and protect wealth through all shifts. That means having a strategic framework that works in multiple scenarios. If inflation persists, you have exposure to real assets. If growth continues, you have equity exposure. If crisis emerges, you have defensive positions and liquidity. No one knows exactly which scenario will unfold, but a properly constructed portfolio doesn't require you to know. It captures upside in favorable scenarios and limits downside in unfavorable ones. This is boring, unsexy advice. It doesn't promise to 10x your money next year. But it's what actually works over time. It's how generational wealth gets built and preserved. Your appropriate response depends on where you are in your investing journey. You have time. That's your greatest asset. Short-term volatility, whether in silver, stocks, or anything else, is almost irrelevant to your long-term outcomes. Your focus should be on consistent contributions, keeping costs low, and building good behavioral habits. If current market conditions are creating attractive valuations in quality assets, continue your regular investment schedule. maybe even accelerate if you have cash available and stability in your income. Do not get distracted by dramatic short-term moves. Do not abandon your long-term strategy for tactical positioning. Time in the market beats timing the market, especially when you have decades ahead. You're in your highest earning and saving years. You're building the bulk of your retirement portfolio. Current market volatility is actually opportunity. You're adding capital regularly. Volatility means you're sometimes buying at better prices. Your risk tolerance can still be relatively high because you have time to recover from drawdowns. But this is also when you start thinking more seriously about diversification, about hedging strategies, about how your portfolio would perform in various macro scenarios. The silver China Wall Street dynamic might inform your thinking about international exposure, commodity exposure, and currency hedging. But it shouldn't cause wholesale portfolio changes unless your existing allocation was already inappropriate. Your priority is capital preservation with sufficient growth to maintain purchasing power. Market volatility matters more to you because you may need to draw on your portfolio soon or are already doing so. Large market moves in either direction should trigger a portfolio review. Are you still appropriately balanced between growth and defensive assets? Do you have sufficient liquidity to meet near-term needs without selling at bad prices? Current conditions might suggest slightly more defensive positioning if you're concerned about a volatile period ahead. But don't panic into cash. Inflation remains a threat. You still need growth assets. The adjustment is incremental. Maybe more short duration bonds, maybe some increase in cash reserves, maybe hedges on concentrated equity positions. Not wholesale change, thoughtful adjustment. Here's a crucial framework for processing market events like this. Tactical moves are short-term adjustments based on current conditions. Strategic positioning is long-term allocation based on enduring principles. Most investors should be primarily strategic with occasional, small tactical adjustments. The problem is, many investors do the opposite. They constantly make tactical moves while neglecting strategic positioning. They chase whatever moved most recently. They try to time every market shift. They treat their portfolio like a trading account. This approach almost always underperforms over time. The alternative, build a strategic allocation based on your risk tolerance, time horizon, and financial goals. Let that drive 85-95% of your portfolio decisions. Then allow for small tactical adjustments, maybe 5-15% of your portfolio, when you have genuine conviction about a macro shift. The silver whale and Wall Street rally might inform a tactical adjustment. They shouldn't reshape your strategic allocation. Unless this event fundamentally changes your view of long-term macroeconomic conditions, currency dynamics, or geopolitical risk, it's a tactical data point, not a strategic inflection point. Treat it accordingly. A word about how you consume financial information. Not all sources are equal. Not all analysis is sound. Not all market commentary is useful. Financial media has incentives to sensationalize, to create urgency, to make every market move seem like the most important thing ever. This serves their business model. It doesn't serve your investment outcomes. Learn to distinguish between daily price moves, short-term predictions, breathless headlines about what just happened, analysis of macro trends, institutional behavior, policy changes, and structural market shifts. Content that improves your understanding of markets, risk, and investment principles. Exciting but ultimately useless content that makes you feel like you're learning but doesn't actually improve your decision-making. Most financial media is noise and entertainment. Very little is signal and education. Seek out sources that help you think clearly about long-term principles, not sources that promise to tell you what to buy tomorrow. This video, ideally, is providing signal and education. We're examining what a market event reveals about macro conditions and how that should inform strategic thinking. We're not telling you to buy or sell anything specific based on 1 week's price action. That's the difference. That's what serves your long-term interests. Everything we've discussed requires emotional discipline. That's the hard part. That's why most investors underperform. Technical knowledge is available to everyone. Market information is widely accessible. Investment strategies are well documented. The constraint isn't knowledge, it's discipline. Can you watch markets move dramatically without feeling compelled to do something? Can you hold a losing position if your analysis says the thesis is still valid? Can you take profits on a winning position if your risk management framework says you should? Can you sit on cash while markets rally if you don't see compelling value? These are emotional challenges, not intellectual ones. The solution is having rules, systems, and processes that remove emotion from decision-making. Professional investors use investment policy statements, position limits, rebalancing schedules, and risk controls. Individual investors can do the same. You don't need complex systems. You need basic rules you commit to following. Write down your strategic allocation. Write down what would cause you to adjust it. Write down position size limits. Then follow those rules even when, especially when, your emotions are telling you to do something else. That's the discipline that compounds wealth over decades. Let's examine the deeper China dynamics because they'll be relevant for years to come. China is navigating multiple challenges: slowing growth, property sector stress, demographic headwinds, and shifting global trade relationships. Chinese policy responses will drive massive capital flows for the foreseeable future. When Chinese institutions move into hard assets like silver, they're making a statement about trust in their domestic currency and financial system. When they move capital offshore, they're hedging against domestic risks. For global investors, this creates persistent themes. The yuan may face long-term depreciation pressure. That affects commodity prices, emerging market currencies, and the competitiveness of Chinese exports. Chinese capital seeking safety may continue flowing into U.S. assets, supporting dollar strength and U.S. asset prices even as domestic concerns mount. The bifurcation between Western and Chinese financial systems may deepen, creating arbitrage opportunities but also new risks. These are decade-long trends, not week-long trades. Understanding them helps you position strategically for a shifting global macro environment. It doesn't tell you what to buy tomorrow. It tells you what structural forces will shape markets for years to come. A portfolio principle worth understanding: anti-fragility. An anti-fragile portfolio doesn't just survive volatility, it benefits from it. How? By being positioned so that large market moves in different directions, both create opportunity. This doesn't mean market timing, it means structured opportunism. You maintain sufficient liquidity so that when markets sell off, you have capital to deploy at better valuations. You maintain some exposure to assets that perform well in crisis: quality bonds, defensive equities, certain commodities. You avoid concentration that makes you vulnerable to any single scenario. If silver crashes from here, you're not devastated because it was a modest position. If it soars further, you benefit from your existing exposure. If Wall Street pulls back, you have liquidity to add quality names at better prices. If it continues rallying, your existing equity exposure captures upside. Anti-fragility isn't about prediction, it's about positioning. It's the difference between needing to be right and being protected, whether you're right or wrong. Here's the truth that brings all this together. You can't control whether Chinese institutions buy silver. You can't control whether Wall Street rallies or corrects. You can't control geopolitics, monetary policy, or global capital flows. You can control your asset allocation, your position sizing, your cost structure, your emotional responses, your research quality, your commitment to a disciplined process. That's it. That's all you actually control. The investors who succeed over decades are those who focus entirely on what they control and accept everything else as the environment they must navigate. They don't waste energy predicting. They build robust portfolios that work in multiple scenarios. They don't react emotionally to market volatility. They execute their strategy regardless of short-term noise. They don't chase performance. They stick to their principles and trust that discipline compounds over time. This is less exciting than trying to call every market move. It's also vastly more effective. So where does this leave you? The silver whale, the China dynamics, the Wall Street rally. These are data points that reveal information about current macro conditions and institutional positioning. They don't tell you what to buy tomorrow. They inform how you think about strategic positioning over the coming quarters and years. Your action items. Review your current portfolio allocation. Does it still reflect your risk tolerance and time horizon? Is anything dramatically over or underweighted after recent market moves? Assess your exposure to the macro forces at play: currency risk, commodity sensitivity, geographic concentration. Make adjustments if warranted, but make them strategic adjustments based on long-term principles, not tactical reactions to recent price action. Recommit to your investment discipline. Remind yourself why you own what you own. Reaffirm your position in size limits and risk controls. Build your watch list for the next opportunity. Identify quality assets you'd like to own at better valuations. Be patient. The power shift in global markets isn't happening in a day or a week. It's unfolding over months and years. You don't need to rush. You need to be thoughtful, strategic, and disciplined. That's how you not just survive, but thrive through major market transitions. Markets will continue to move. Capital will continue to shift. Volatility will remain a constant feature of investing. Your job isn't to predict every move. Your job is to be positioned so that you can benefit from long-term market growth while managing the risks that come with pursuing those returns. The investors who do this successfully aren't the ones making the most trades or having the strongest opinions about what comes next. They're the ones with the clearest principles, the strongest discipline, and the longest time horizon. That can be you. The knowledge is available, the principles are proven. What remains is commitment. Commitment to a process, to emotional discipline, to thinking long-term even when markets demand short-term reactions. If you can maintain that commitment through periods like this, through dramatic headlines and volatile price action, you'll build wealth that lasts. Not because you outsmarted the market, because you outweighted it, because you stayed rational when others were emotional, because you trusted proven principles over exciting predictions. That's the path. That's what works. That's what separates investors who build generational wealth from those who chase performance and wonder why it never quite materializes. The power shift will continue. Capital will keep moving. Markets will keep surprising us. Your discipline doesn't have to shift. Your principles don't have to change. Hold the course. Trust the process. Focus on what you control. That's how you win the long game. Thank you for your time and attention. Until next time, stay disciplined and stay focused on what truly matters.